Welcome to the Explainer. Now, if you're involved in international trade, you already know the deal. This environment is incredibly unforgiving. A single, tiny, overlooked detail can turn a highly profitable deal into a catastrophic financial loss. But today, we're going to flip the script. We're transforming those scary risks into a step-by-step, highly actionable how-to guide. We're building a flawless blueprint for consistent profit. Let's dive in.
So, here's our step-by-step agenda for today. First, the high stakes of trade. Then we move to Step 1, secure your supplier. Step 2, protect your money. Step 3, perfect your paperwork. And Step 4, master compliance timing. Finally, we'll wrap up with the blueprint for profit.
Section 1. The high stakes of trade. Small mistakes, big losses. Trade smart, trade right. That really says it all, doesn't it? In this arena, casual operational mistakes are literally the enemy. They directly lead to wiped-out margins, delayed shipments, and just severe financial losses. Before we get into the exact tactical steps, we really need to frame the reality of the arena we're operating in. International trade demands absolute, unwavering intentionality. There are 12 catastrophic, super common mistakes that traders make on a daily basis. We're talking everything from confusing Incoterms to ignoring currency exposure to just sloppy record-keeping. Now, I know it looks intimidating, but here's our secret weapon. We are going to use this exact list of failures as our step-by-step map. We'll use it to build a foolproof execution strategy to make absolutely sure we succeed.
Section 2. Step 1. Secure your supplier.
Okay, every successful trade starts with a rock-solid foundation. First, you've got to implement strict due diligence, and I mean taking real, clear actions, like hiring third-party inspection services or demanding factory audits. Doing a quick Google search just isn't going to cut it to weed out fake suppliers. Second, you need crystal-clear delivery timelines and exact quality specifications explicitly written into your contract. And finally, enforce strict penalty clauses. Look, if you don't have penalty clauses, you have zero legal protection when delays inevitably happen. Nailing this prevents massive financial loss right out of the gate.
Now, when you're handling the money, paying 100% upfront is a massive, completely unnecessary risk. It leaves you entirely exposed to fraud and non-delivery. So what's the smart, actionable alternative? You actively manage your payment risk by using secure instruments like letters of credit. This is a game changer because it guarantees your supplier only gets paid when they have actually proven with authenticated documents that they shipped exactly what you ordered.
Moving on to Section 3. Step 2. Protect your money.
All right, so we've got the supplier locked in, but now we need to aggressively defend your bottom line from hidden fees and sudden currency shocks. First up, Incoterms. A very common and very expensive mistake is assuming that CIF, which stands for cost, insurance, and freight, covers literally everything right to your door. It definitely does not. It does not include destination charges like local customs clearance fees or warehouse storage. You absolutely must know exactly where your cost liability ends so you aren't blindsided by unexpected invoices.
You have to calculate your total costs up front to avoid these hidden logistics traps. Port and terminal handling charges, those will unexpectedly inflate your landed cost. Inland transport can easily blow right past your planned logistics budget. And demurrage? You know, those fees you pay when your cargo sits at the port too long waiting to be cleared, that can erase your profit margins entirely. Oh, and please, whatever you do, do not skip cargo insurance to save a tiny bit of upfront cost. Just one single incident of damage or theft means a total wipeout of your investment.
Here's another massive threat to your money: currency exposure. Pricing your goods without considering exchange rate fluctuations means your entire margin could vanish while the goods are literally just sitting on a ship in transit. The smart action here is building an FX buffer. For instance, you actively absorb Naira volatility by baking a buffer directly into your initial pricing model. That is how you protect your margins from wild, unpredictable currency swings.
Section 4. Step 3. Perfect your paperwork.
Listen, you can have an amazing supplier and the most perfect cost analysis in the world, but if your paperwork is flawed, your cargo is going absolutely nowhere. Specific paperwork errors lead directly to devastating consequences. Take a misclassified HS code, like getting a single digit wrong on code 3004.90. That simple typo triggers an immediate customs inspection, the wrong duties being applied, and really heavy financial penalties. Invoice inconsistencies, or a missing packing list? Boom, immediate cargo delays and extra port charges. And an incorrect bill of lading creates massive bottlenecks. Every single document must align perfectly, no exceptions.
If you're bringing goods into highly regulated markets, let's take Nigeria for example, ignoring regulatory requirements is just fatal to your deal. Taking action on specific regulatory approvals is non-negotiable. You have to open your Form M prior to shipping. You have to secure NAFDAC product approvals and CON regulatory approvals. You must ensure strict compliance with central bank and customs rules. Because if you skip these actions, you aren't just facing a slap on the wrist or a small fine, you are facing outright seizure or the complete rejection of your goods.
Which brings us to Section 5. Step 4. Master compliance timing. Having the perfect paperwork means absolutely nothing if your timing is wrong. Trade operations are like a highly synchronized clock, and timing errors are critical. On day 1, you must open Form M and secure your approvals before the goods are even loaded onto the ship. If you ship before getting approval, you immediately trigger massive payment delays. Fast forward to week 4, and you should be continuously monitoring shipping operations and tracking your payments. By week 6, if you fail to factor in weekends and public holidays for customs clearance, that will inevitably lead to demurrage, severe delays, and completely ruin your reputation with your local buyers.
Now, underpinning this entire timeline is one absolutely critical continuous action: keep proper records. For every single shipment, you need to maintain a dedicated, shared digital folder where your commercial invoices perfectly match your SWIFT receipts. If you can't rapidly reconcile your documents when asked, you are going to face severe compliance issues and awful audit failures down the line. Meticulous record keeping is what keeps you firmly in control of the entire process.
Section 6. The blueprint for profit. All right, let's bring it all together. We've built your how-to checklist, and it consists of 4 strong structural pillars. Pillar 1, supplier verification. 2, comprehensive risk management. And that covers your payments, your logistics, and building in those foreign exchange buffers. 3, uncompromising documentation accuracy. And 4, strict regulatory compliance. If you execute these 4 steps sequentially, you completely neutralize the common pitfalls that destroy other traders. The absolute bottom line from our source material today is crystal clear. International trade rewards precision. Be professional. Be compliant. Be profitable. Precision isn't just about trying to avoid a slap on the wrist from customs. It is the direct pathway to consistent profitability. The single biggest mistake you can possibly make is treating this operation casually. So, I want to leave you with a final challenge to audit your own operations. Are you treating international trade casually, just leaving things to chance and hoping for the best? Or are you executing with flawless precision using a structured blueprint? Take these practical steps, apply them to your very next deal, and just watch your risk drop as your margins hold strong. Thanks for joining me on this explainer, and I look forward to seeing you master the high stakes of global trade.